Hello and welcome to another episode of Full Court Finance here at Zack's. I'm your host, Ben Rains, and this week we're going to be doing something a little different. We're going to be diving into three companies in the broader sports industry that are either Zack's number one or number two buys. Strong buys this week. So we're going to be diving into these companies and seeing what makes them so intriguing right now. But before we do that, I want to just say, remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com because we always really appreciate any listener feedback whatsoever. So we have the Major League Baseball playoffs starting. The NFL is already more than a quarter of the way through the season if you don't count Monday Night Football tonight. You have hockey back. NBA basketball is back on TV, which is crazy enough. So we'll dive into some of that in some upcoming episodes. But I really wanted to talk about some companies and do something a little different this week and kind of just talk about why these three companies look so attractive at the moment, especially since consumer confidence is riding pretty high at the moment, and we're heading into the holiday shopping period. So today we're going to dive into why Lululemon, this is a company I've talked about a couple times on the show, along with Callaway Golf and Columbia Sportswear, are all Zack's ranked number one or two buys in strong buys stocks as of right now. So if you're listening to this maybe on a later date and you go to Zacks.com, they might not be these rankings at that time, so I don't want to throw people off. These are fluid rankings, so they could change by the time you're listening to this, but that's what they are now, and they're no matter what, by the time you look at it, it's still going to be a strong company that's headed in the right direction. And I want to start with Lululemon. It's a company that I've talked about a couple times on the show, and I really do think that they have a strong business model going forward that really is going to be able to compete for a long time, or at least in the next couple of years, barring fashion can always change. So maybe no one does yoga or wears these clothes in 5 years. Who knows? They have no control over that. But for now, it's looking like they're set up for a pretty strong run. So their second quarter revenues are up 25% to just about $725 million. And the big thing here, though, was that their second quarter earnings were up huge. They're up 97%, which destroyed our estimate of 49 cents per share. So up 97% and crushed our estimate. But then maybe more importantly were comparable store sales, which is always a huge thing for any retailer, comp sales. That was up 10%. And then their direct consumer push, which you will now pretty much hear from every retailer till the end of time, until there are no more. They can't say it anymore. It's direct to consumer, direct to consumer, direct to consumer. That was up 48%, so that's a great sign. And it's still not the biggest portion of their business, but for a frame of reference, it accounted for 23% of revenues in the second quarter, up from 19.5% the year before. So that's some steady growth there. So they're about a fourth of their business is now coming from online direct-to-consumer e-commerce sales, which is great. So the Canadian retailer like Nike and Adidas and even Under Armour and pretty much every retailer, they're really pumping out this e-commerce push. That's kind of how the market's trending, and it's also good for business, helps with margins as well. And then going forward, if you're paying attention to Lululemon at all, some places they could definitely grow are Asia and Europe. 73% of their store locations at the moment are in either the United States, Canada, or Australia and New Zealand. So they have 415 stores, and as I said, 73% are in Canada, Australia, New Zealand, and the United States. So going forward, they're really going to try to make a bigger push into some Asian markets, including China. But as I've talked about now a couple times in the show, that the broader athleisure industry, which they're dominant in, is growing. You have the NPD group, who does a lot of market research for apparel and other things as well, basically saying that there's talk that it's now become kind of a bubble. This can't be sustainable. You had a quote from Marshall Cohen, who is the chief industry advisor for retail over there, saying other apparel categories are declining, which tells us that consumers just want what they need and want in other, or are getting what they need in athleisure. There's no doubt that the category will continue to evolve, but is definitely here to stay for the foreseeable future. So that being said, you also have companies like Gap's Athleta, who's done really well in this category, and they're even now pushing out a men's counterpart, which is Hill City, which I talked about on this program a couple weeks ago. And then specifically Lululemon is talking about bumping up their menswear business to $1 billion by 2020 and hit an overall goal of $4 billion by that same time period. So for it to then take about a quarter of their business, which would be a pretty big deal for them. But now I want to look at some of their estimates, because that's really what's going on with this Zack's rank, and that's why the company looks good going forward. So for the third quarter, their revenues are supposed to jump about 18.5%. And then for the full year, they're expected to be up just under 22%. So some good top line growth, and these are based on our Zack's consensus estimates. And then for the bottom line, so their adjusted earnings, this is what really is going into this Zack's rank for the third quarter, supposed to be up just over 21%. And then for the full year, this is the big deal here, supposed to be up 38%, which is pretty huge for this company. And then pretty much all of their, well, not pretty much, I'm looking at the chart right now, they've had a ton of upward earning estimate revisions over the last 60 days, and not one of them is going downwards. So the key here is for the current fiscal year and fiscal 2019, they've had 18 estimates for the current year in the last 60 days. They're all going up. And then for fiscal 2019, you had even more. You had 23 estimates for 2019, all going up. So that's why they're currently at Zack's rank number 1, which pretty much means, if you're not familiar with these rankings, that analysts are upping their outlook for the bottom line so they're revising it upwards. They see strength in the business, and that is pushing Lululemon to be a Zack's rank number 1. And then just for a little frame of reference, they don't only sell traditional yoga and athletic wear. Since we're heading into the holiday season, they sell a lot of outerwear, winter, fall gear that's, once again, pretty expensive. So $150 jackets or $150 vests, $300 down jackets. So there's some good business there. So the holiday shopping season will certainly help them, most likely. And my producer, Danny, just held up a note that says shoes ? Because he's reminding me that, yes, Lululemon does sell shoes, and at a pretty high price point, to say the least. So I just looked it up as we were talking. They're owned by Lululemon, but they're under a brand called APL. And some of the price points are kind of crazy high. They're selling some shoes for $250. They're running shoes. There's some other ones that are kind of priced at a Nike range, but in between $200, $250, $185, all pretty high priced shoes. So that's another thing that could do well during the holiday period, because people are always looking for a little bit pricier gifts for people in the holiday season. So yeah, thanks, Danny, for pointing that out. And now we're going to transition to another company that's been on a tear recently, and that is Callaway Golf Company. That's the ticker ELY. And it's kind of funny that golf season pretty much just ended officially. Last week, you had the U.S. losing the Ryder Cup in abysmal fashion to Europe. But the big thing here, and what you're going to hear now everyone talk about in the business world and television ratings, is the Tiger's back, baby. Tiger's back. You had Tiger Woods winning the last PGA Tour event of the season. It was his first win since 2013. When that season, I believe he won 5 times and was pretty dominant, even though that seems now like it was ages ago. But pretty much for the last 20 years, the sport of golf lives and dies, at least on the broader sense of a larger appeal based on how Tiger Woods is playing. And that is not just me. That is any article you read anywhere, from the Wall Street Journal to CNBC to anything, as soon as Tiger Woods won, I think now is 3 weeks ago, does that sound possible? But near the end of a couple weeks ago, he won the last event of the year. It's just, the ratings are up huge. Tiger's back. Golf is back. It's pretty much just, as long as Tiger's doing well, everyone who is involved in the business of the PGA is just licking their chops to get into that 2019 season. With Tiger coming off a win, ESPN, CBS, all the business partners are really getting excited. But back to Callaway. You had, at the end of September, JP Morgan's Stephen Zacconi, and I'm sorry, Stephen, if I didn't pronounce your last name right, but he wrote in a note to clients that he really believes that Callaway is going to see a big bump from this Tiger push and a broader appeal of golf over the next year. So he was talking about how Callaway's management team sees the golf market improving on a, quote, multi-year basis amid rising interest in the game. In that, as I said, it's likely going to mean higher PGA Tour viewership to start the 2019 season. And Zacconi raised his price target on Callaway shares up to $27 a share from $25 per share, which at the time marked a 14% upside to the closing price the previous day. And at the moment, it's about that same 14% upside. The funny part here, though, is that Zacconi is referring to Tiger Woods, and all of these people who talk about the business of golf are referring to Tiger Woods. And it's the sense that the tide lifts all boats, because Tiger's not sponsored by Callaway whatsoever. He's actually sponsored by TaylorMade, who's a Callaway rival, pretty much directly. Those are the two of the bigger players, because Tiger now is sponsored by TaylorMade, because Nike, as some people might know, no longer makes golf equipment. They got out of that about a year ago. And so Tiger is still a Nike apparel sponsor, and now with TaylorMade. But in terms of Callaway, they're coming off their best ever second quarter on both the top and bottom line. Their sales were up 30%. Their adjusted earnings per share up 91%. And as I said, this marked record net sales and earnings for the second quarter and the first half of 2018 as well. In some of the interesting, so all of their categories were up. You had their gear sales up 64%. So that's kind of directly tied. Just because Tiger's playing well in golf doesn't mean you're necessarily going to go out and buy new golf clubs. That's a big investment. That's expensive. I don't think that's a whim purchase, but the sense that if you play golf at all, you go buy a new polo, a new jacket or something, you want to play more often, you want to have some of the newest gear. So it's crazy to think that, yeah, their golf ball sales are up 35% and their gear up 64%. And then in terms of their regions, U.S. sales were up by the most. They were up almost 39% for the quarter, while you had the rest of their rest of Asia category, which is everyone that's not Japan, because they have Japan broken out. So that was up 25%, and the rest of Asia was up over 36%. So basically, they were doing very well, gear doing really well, and U.S. sales up almost 39%. And the company sees big things coming forward as well, because they raised their full year guidance at the end of the second quarter. And then this is also from Zacconi, and this is a quote. Callaway is the market leader in hard goods, which is clubs and balls, with 26% market share in the U.S. as of July, up from 14% in 2012. So that's a pretty big jump in a 5-year period or so, 6-year period. But management still sees opportunity for incremental share gains across the entire portfolio. And that's, once again, from the JP Morgan analyst. So things are trending upwards for Callaway. And then I'm going to just talk a little bit about, like I did for Lululemon, why they have this strong Zack's rank. And it is pretty much because their full year estimates are looking great. Their revenues are expected to be up about 17% to $1.23 billion. And their earnings, their adjusted earnings, are expected to be up just under 89%. So 88.68%. Huge jump on the bottom line. So they're not only growing revenue, but they're becoming more profitable while doing so. And they've had a ton of upward earning estimates for the full year and their next fiscal year as well, which is a reason why they are, once again, a Zack's rank #1 strong buy that looks like they're going to really be able to continue this run for at least a little bit more time. And now I want to transition into my last company, and that is Columbia Sportswear. It's not as much of a traditional, you wouldn't necessarily think of them as a sports company, but it is an outdoor brand. It's involved with skiing, hiking, all of that stuff. So it's as close to a sports apparel company as you can get, in my opinion. They're an outdoor sporting giant. It's like Patagonia or North Face, any of those companies. And just for reference, they also own Mountain Hardwear. If people have probably seen those coats around in Sorel boots, which have become widely popular once again. They've been around for forever. I have a pair. They're great. And then a company I never heard of, they also own. It's Prana. It's PR and then capital ANA, Prana. So it's a smaller one of their segments. But just like Callaway, they're coming off a record-setting second quarter on both the top and bottom line. So this whole outdoor and larger sports apparel market has done really well recently, and a lot of this is to do with growing consumer confidence and all of this, as I mentioned at the top a little bit. So yeah, their second quarter sales were up 21%. In Columbia specific revenues were up 22%, but the big winner here was Sorel brand revenues. They were up 90% last quarter. So as I mentioned, they make rain boots, winter boots, pretty quality at a high price point. So there's likely a pretty good margin on there. So look for that Sorel brand to continue to grow, but it is pretty small portion of their business. Just for reference, it pulled in 11.4 million during the quarter when the entire company pulled in 481 million. So very small portion of their business still at the moment, but those sales are likely going to be a little higher in the winter/fall quarters when more people are looking for outdoor rain/snow boots. And then Mountain Hardwear sales were down 1%. In that Prana brand, sales were up 9%. So the only brand that suffered was that Mountain Hardwear company, which it's the summer. It's a little harder to bring in sales for a company that's selling vests and jackets and all that jazz. But it's interesting to see that the rest of their business was booming so well, and that Mountain Hardwear was dipped a little bit. It also, as I've said now too many times, but it's really just because that's what all of these retailers are talking about, and that's what all of these retailers are focused on. Throughout their earnings call, Columbia was really talking about their direct consumer push like everybody else. But really, it all comes down to what's going to go on forward, because they've already done well. And if you haven't been in Columbia stock, this doesn't really matter to you that they've done so well going forward if they're not going to continue this run. So for the full year, they are expected to see their sales jump about 9.6% to $2.7 billion. So some good growth there on the top line. And then their adjusted full year earnings are expected to be up about 16.8%. And as I've said now, they're a Zack's ranked #1 strong buy because their earnings estimates for the full year and the next fiscal year have been trending upwards almost completely. They've had 6 estimates in the last 60 days that are all trending upwards for both fiscal 2018 and 19. So that's why Columbia is once again a Zack's ranked #1, and all of these stocks are trending in the right direction. And I kind of just want to touch on, I have a chart here pulled up of just how these companies have performed over the last year to give people a sense of who's been the top performer of these sportswear companies I've talked about. So Lululemon is up almost 100% over the last year, which really is crazy. And then Callaway is the second best performer out of this group of companies that I've spoken about, and they're up just about 69%, which for reference, the S&P is up just under 10%. So those companies have crushed the S&P. Columbia is up about 25%, and that's been pretty sideways over the last couple months, whereas Lululemon has trended upwards in the last couple months. And yeah, so there's a lot going on there, and I kind of want to close with what I was talking about at the start, which is consumer confidence going into the holiday season, because that's where a lot of these retailers can get a boost. Is that consumer confidence in September hit an 18-year high, which is, a great sign going into the holiday shopping period for all of these retailers, because it says that American consumers are more excited about the future than they were before. So the Conference Board is where this number is coming from. It's widely used pretty much. This is where this consumer confidence index, if you ever read about it, is coming from. It rose to 138.4, which is kind of an arbitrary number, up from 134.7 in August. So it was the highest level since September of 2000. And it represents the last time consumer confidence was this high was in the late stages of the 1990s tech bubble. So I don't know if that's a bad sign or a good sign, but for now, things are looking good for all of these retail consumers, and the holiday shopping period should be a good one. So yeah, we talked about Lululemon, Callaway, and Columbia as being really strong Zack's rank stocks that look like they're trending in the right direction. And over the next couple of weeks, we're going to kind of get back into the business of these sports that have started back up and touch on some sports gambling in reference to the NBA and the NHL and where all of these big leagues are going forward with that. But that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.